Suncor Energy investment thesis rests on the firm's integration of vast, long-life upstream oil sands assets with high-efficiency downstream refining and marketing operations, a combination that intrinsically hedges against commodity price volatility and regional differentials. The recent operational focus, implemented by current management, has generated tangible momentum. The third quarter of 2025 proved exceptionally strong, highlighted by the achievement of a record upstream output of approximately 870,000 barrels per day, representing an impressive 8% quarter-over-quarter growth. This execution drove Q3 2025 net earnings to see $1.62 billion, a notable increase compared to the $1.13 billion realized in the second quarter of 2025, achieved despite only a minimal increase of roughly $1 per barrel in the West Texas Intermediate or WTI crude price. This capacity to grow earnings without a strong commodity tailwind validates the structural improvements implemented across the value chain. The firm generated $9.6 billion in adjusted funds from operations (AFFO) year-to-date through Q3 2025. The management team's primary commitment is the maximization of free funds flow (FFF) per share, supported by rigorous capital discipline and a robust balance sheet. This commitment is evidenced by a conservative net debt to AFFO ratio of only 0.5 times on a trailing 12 months (TTM) basis as of Q3 2025. The primary structural defense for Suncor is its integrated nature. The company possesses oil sands reserves indexed at a substantial 25 years, providing high-volume visibility and eliminating the need for expensive exploration spending typically required by international majors. This stability allows the company to operate profitably even in a challenging crude environment, proving its ability to grow volumes even in a meh oil tape. Despite this operational strength and long-life asset base, Suncor stock currently trades at a relative discount. The forward price-to-earnings multiple is approximately 13.5 times, and the latest 12 months (LTM) enterprise value to earnings before interest, taxes, depreciation, and amortization (EV/EBITDA) is calculated at 5.6 times. This valuation is materially below that of many global integrated peers. The company is actively addressing this perceived undervaluation through aggressive capital returns, including the repurchasing of $1.7 billion in shares year-to-date through the third quarter of 2025. The ability of Suncor to significantly boost quarterly earnings with nearly flat WTI prices demonstrates that the company's profitability drivers have fundamentally shifted. Earnings generation is moving away from being purely sensitive to commodity price fluctuations, commodity beta, toward growth driven by operational excellence and efficiency improvements, alpha generation. This shift provides stability, which is a key component for long-term institutional investment. Key risks. The most significant structural risk remains the potential regulatory exposure inherent in the Canadian oil sands. The concentration of upstream assets exposes Suncor to the ongoing political debate regarding the proposed federal oil and gas emissions cap. While the government has positioned the cap as a volume-neutral cap-and-trade system, the risk of potential production curtailment is real and impacts the long-term economics of its reserve base. Furthermore, profitability is vulnerable to external macroeconomic volatility. Independent forecasters project 2026 West Texas Intermediate WTI oil prices may settle in the lower range of the mid-50s per barrel, which, coupled with a potentially prolonged widening of the Western Canadian Select differential, could pressure margins. Brokerage analysis reflects confidence in the company's turnaround, yielding an overall consensus of moderate buy. The composite of analyst projections pegs the average price target at $47.72. This target implies an upside potential of approximately 8.6% from recent trading prices, suggesting a strong consensus view that the stock is currently fundamentally undervalued. The substantial difference between Suncor's EV/EBITDA of 5.6 times and that of peers like Imperial Oil, which trades at 8.1 times, is attributable to a historical risk premium linked to past safety and operational reliability issues. Consistent, robust quarterly execution demonstrated by high utilization rates, such as the 101% achieved in the Downstream segment year-to-date Q3, serves as the necessary catalyst for institutional re-rating. IV, the strategic advantage of integration and upstream dynamics. Asset quality and long-life resources. Suncor's core competitive advantage stems from its world-class oil sands assets. These assets provide predictable, long-term production with low decline rates, contrasting sharply with conventional exploration and production E&P firms. The Exceptional Reserve Life Index, calculated at 25 years as of 2024, is a central pillar of the investment case. This longevity ensures a structural capital efficiency advantage because management can allocate capital primarily to sustaining projects and highly accretive extensions, rather than the risky, high-cost capital deployed for reserve replacement often required by global rivals. Operational execution and production growth. The management's relentless focus on operational stability has translated directly into increased volumes. Upstream output reached an all-time record production of approximately 870,000 barrels per day in the third quarter of 2025. This impressive growth of 8% quarter-over-quarter proves the company's ability to meet and exceed its volume targets. For the full year 2025, corporate guidance projects annual upstream production in the range of 810,000 to 840,000 barrels per day. This guidance is formulated conservatively, accounting for significant planned maintenance activities, including a substantial 91-day outage at Base Plant Upgrader necessary for the critical coke drum replacement project. The fact that the Q3 2025 record output of 870,000 barrels per day already exceeds the high end of the full-year guidance, 840,000 barrels per day, indicates that management has modeled ample conservatism to accommodate the scheduled downtime. If Suncor can execute the necessary maintenance flawlessly and minimize any unplanned operational disruptions, there is substantial potential for full-year production volumes to outperform guidance, creating a powerful catalyst for positive earnings surprises. The company's planned capital expenditures, totaling $4.2 billion year-to-date through Q3, are being strategically directed towards sustaining the core business and funding key high-value economic opportunities, such as the development of the Mildred Lake West Mine Extension and the West White Rose projects. Cost structure and competitive position. Management has set an ambitious goal to significantly enhance financial resilience by targeting a reduction of its corporate WTI break-even price by US $10 per barrel. Based on recent estimates, Suncor's operational break-even price is approximately $40 WTI. While this represents a significant improvement from historical levels, it still lags the reported industry-leading figure maintained by Canadian Natural Resources, which is widely cited as profitable in the low 30s WTI. This efficiency gap underscores the necessity for Suncor to continue prioritizing cost reduction initiatives to enhance its competitiveness within the Canadian energy landscape. IV, Downstream and Refining Margin Outlook. The value of integration and capacity metrics. The integration of oil sands production with conversion and refining assets is the cornerstone of Suncor's defensive strategy. This structure allows the company to minimize its exposure to volatility in the Western Canadian Select heavy oil price differential. Suncor controls significant downstream assets, including 556,000 barrels per day of upgrading capacity and 466,000 barrels per day of refining capacity. The ability to internally process discounted heavy Canadian crude and transform it into high-value synthetic crude oil, SCO, and refined products captures the value that would otherwise accrue to third-party refiners, serving as a powerful stabilizer for corporate earnings. Exceptional downstream performance and utilization. Operational stability in the downstream segment has been exceptional, achieving an outstanding refinery utilization rate of 101% year-to-date Q3. This achievement, which exceeds theoretical nameplate capacity, reflects superior asset management and optimization. For 2025, the company projects annual refining utilization to remain strong between 93% and 97%. This guidance appropriately incorporates the impact of planned turnarounds, specifically a 58-day outage at the Edmonton refinery and a 40-day outage at the Sarnia refinery. A crucial element of Suncor's defense is its investment in maintaining the complexity of its facilities, such as the replacement of the Base Plant Upgrader coke drums. While this is a substantial capital commitment, it is necessary to secure the long-term integrity of the most sophisticated conversion units. Successful completion of this project is vital for guaranteeing the company's ability to consistently process raw bitumen into premium SCO, ensuring Suncor remains a price taker for higher-value products. Refining margin forecast and geopolitical advantage. The outlook for refining spreads in North America remains favorable. Structural constraints on U.S. refinery capacity, particularly on the West Coast due to plant closures, are forecast to keep regional product margins robust. Gasoline prices on the West Coast, which typically represent the highest cost market, are forecast to average $4.10 per gallon in 2026. This fundamental strength in the refining margin provides a significant counter-cyclical buffer. The integrated asset base also acts as a critical hedge against adverse geopolitical trade policy. For instance, the expected narrowing of the WCS price differential to $48 per barrel in 2026 is predicated on the critical assumption that the 10% U.S. tariff on Canadian energy products is phased out. If geopolitical factors prevent this tariff removal, leading to a sustained widening of the WCS differential, Suncor's upstream revenue would suffer. However, the downstream segment would benefit disproportionately from the ongoing discount on feedstock, minimizing the net negative impact on the overall corporation. Furthermore, Suncor continues to strategically invest in its marketing segment through the execution of its Petro-Canada retail network improvement plan. IV, Financial Performance and Cost Management Deep Dive. Recent financial results and profitability metrics. Suncor's financial results demonstrate high operating profitability and efficient capital utilization. Adjusted funds from operations (AFFO) in the third quarter of 2025 reached $3.831 billion, equating to $3.16 per common share, an increase compared to the $3.78 billion, $3.98 per common share achieved in the prior year quarter. This strong performance contributed to total AFFO of $9.6 billion for the first 9 months of 2025. The company maintained a robust financial performance, achieving an approximately 11% net margin during the first 9 months of the year. Capital discipline and free funds flow generation. The emphasis on disciplined capital management is reflected in the strong generation of free funds flow. Year-to-date through Q3 2025, capital expenditures totaled $4.2 billion, while the company successfully generated a higher FFO of $5.2 billion. Suncor's 2025 capital budget is planned within a range of $6.1 billion to $6.3 billion. Critically, the preliminary capital spending plan for 2026 is lower, estimated at approximately $5.7 billion. Management has explicitly stated that this 2026 budget would be subject to further trimming if weaker commodity prices persist, providing essential financial flexibility to withstand potential commodity price weakness. This willingness to trim the 2026 budget confirms a strategic shift away from potentially over-aggressive capital deployment, directly addressing the risk posed by independent forecasters who project WTI in the low to mid-50s per barrel for 2026. By prioritizing the protection of FFF over deploying capital into marginal operational projects, Suncor strengthens its ability to maintain shareholder returns across the commodity cycle. Balance sheet strength and leverage. The company maintains an exceptionally conservative balance sheet. Suncor reduced its long-term debt by $737 million to a total of $8.61 billion. This minimal debt load is reflected in the extremely conservative leverage ratio. Net debt to AFFO TTM Q3 2025 is only 0.5 times. The low leverage profile significantly de-risks the company, ensuring that interest expense remains negligible, representing only about 1.2% of total revenue. While Suncor's operational break-even price, around $40 WTI, is slightly higher than that of Canadian Naturals in the $30 WTI, its notably lower financial leverage, 0.5x net debt AFFO, provides superior financial resilience. This structure means Suncor can comfortably cover its dividend and base maintenance capital requirements, even if WTI prices temporarily fall closer to its cash break-even point, minimizing financial risk at the expense of marginal operational cost leadership. V. Capital allocation and shareholder return. Shareholder value prioritization. Suncor's current strategic objective is explicitly centered on maximizing shareholder returns, with the core goal being the growth of free funds flow per share. This commitment is enacted through a potent combination of stable dividends and aggressive share repurchases. The firm returned substantial value to shareholders in the second quarter of 2025, totaling $1.45 billion, composed of $750 million in share repurchases and approximately $700 million in dividends. Scale of repurchase program. The share repurchase program is critical to the equity story and provides tangible evidence of management's view on valuation. Year-to-date through July 31, 2025, Suncor allocated approximately $1.7 billion towards share repurchases, retiring 33.3 million common shares. This cumulative action reduced the common shares outstanding by the equivalent of 2.7% compared to the December 31, 2024 share count. This aggressive buyback pace is a direct signal that management views the stock as undervalued, particularly given its lower-than-peer EV/EBITDA multiple. By deploying excess FFO into retiring shares at a discount, the company effectively increases future earnings per share and maximizes returns with minimal operational risk. Dividend policy. The company maintains a secure and attractive dividend policy. The current quarterly dividend is set at C0.57 per share, resulting in an appealing dividend yield estimated between 3.7% and 4%. The achievement of lower corporate WTI break-even prices further strengthens the sustainability and safety of this dividend across typical commodity price cycles. The high volume of capital returns confirms that the company has successfully exited its operational de-risking phase following historical governance challenges. Funds previously required for urgent safety remediation and organizational restructuring are now structurally available for consistent distribution to shareholders. V. Comparative valuation analysis. Market positioning and discounted multiples. Suncor's robust financial profile and asset longevity contrasts with its current valuation metrics. The company's market capitalization is approximately $53.5 billion, with an enterprise value of $61.7 billion. As previously noted, the estimated forward price-to-earnings multiple is around 13.5 times, recognized as a discount compared to global integrated peers given the company's long-life reserve base. More critically, Suncor's latest 12 months EV/EBITDA stands at 5.6 times. Peer benchmarking analysis. When Suncor's LTM EV/EBITDA of 5.6 times is benchmarked against its closest Canadian oil sands peers, a notable valuation discount emerges. Cenovus Energy Inc. trades slightly higher at 5.9 times LTM EV/EBITDA. Canadian Natural Resources Limited, CNRL, despite its superior operational cost structure, trades at 6.9 times LTM EV/EBITDA. Imperial Oil Limited, an ExxonMobil subsidiary, trades at the highest multiple of 8.1 times LTM EV/EBITDA. The substantial spread between Suncor, 5.6x, and Imperial Oil, 8.1x, is not solely attributable to operational differences. This valuation gap reflects a persistent discount related to the historical risk premium that resulted from Suncor's past safety record and governance failures, which led to activist investor intervention in 2022. As management continues to demonstrate improved operational stability and safety excellence, the risk premium should logically dissipate, driving a convergence toward the multiples of its Canadian peers and unlocking significant intrinsic value for shareholders. This potential for multiple re-rating is a key component of the overall upside potential. The analyst community maintains a relatively tight spread in its forecasts, with price targets ranging from a low of $41.04 to a high of $53.38, yielding an average target of $47.72. This relative consensus provides a strong valuation floor and minimizes the risk of stock volatility driven by outlier research. 7. Macroeconomic headwinds and commodity price sensitivity. WTI price forecast uncertainty. Suncor's cash flow generation, while protected by integration, remains tied to the global WTI benchmark. The industry broadly maintains a bullish stance, with corporate expectations placing 2026 WTI prices around $64 per barrel, albeit revised downward from an earlier expectation of $70. Independent macroeconomic forecasters, however, present a more cautious outlook, projecting 2026 WTI prices to settle in the more challenging range of the low to mid-50s per barrel. Management's plan to reduce the corporate WTI break-even price and its commitment to a flexible 2026 capital budget are crucial preemptive steps to defend FFF against this downside risk. WCS differential dynamics. The upstream segment's direct profitability is also highly sensitive to the WCS-WTI differential. Under a tariff case scenario, the WCS price is forecast to fall to US $45 per barrel in 2025, partially driven by the persistence of a 10% US tariff on Canadian energy products. The forecast anticipates an improvement, with the WCS price reaching US $48 per barrel in 2026, but this positive trajectory is contingent on the political assumption that these trade tariffs are phased out. If tariffs are sustained, the differential will remain wide, exposing Suncor to political arbitrage risk. However, the integrated model ensures that a wider WCS discount translates into cheaper feedstock for the downstream, thus mitigating the corporate earnings impact. Downstream countercyclicality. The forecast strength in the downstream refining sector provides a vital countercyclical buffer. Refinery capacity constraints, such as the scheduled closures on the U.S. West Coast, are expected to keep regional gasoline prices elevated, forecast to average $4.10 per gallon in 2026. This fundamental strength ensures that even if WTI prices fall and the WCS differential widens, the refining segment can utilize discounted feedstock to generate strong crack spreads, stabilizing overall cash flow and reinforcing the value of the integrated strategy. 8. Governance, regulatory, and sustainability risk assessment. Governance and safety turnaround. The most significant improvement in Suncor's qualitative profile is the successful turnaround of its operational culture and safety record, a direct response to prior underperformance and activist investor pressure. Under the new management, Suncor reported 2023 as its safest year ever. Key operational achievements included the first year since 2015 with no life-altering or life-threatening injuries, and a significant, nearly 50% reduction in lost time incidents year over year. This safety improvement is highly relevant to the investment thesis because safety performance acts as a leading indicator of core operational reliability. Fewer incidents translate directly into reduced unscheduled downtime and improved efficiency, which directly supports the record utilization rates of 101% in the downstream segment and the robust upstream volumes. This enhanced stability lowers the perceived operational risk, which is necessary for the market to re-rate the stock closer to its peers. Regulatory risks. The federal emissions cap. The regulatory framework announced by the Canadian government for capping emissions in the oil and gas sector based on a national cap-and-trade system presents a material long-term sovereign risk. Provincial analyses have issued stark warnings regarding the potential economic impact. Estimates suggest that if the cap necessitates production curtailment, Alberta could suffer annual GDP losses ranging from $19 billion to $27 billion, leading to potential job losses reaching 92,400 by 2035. This regulatory uncertainty introduces a punitive element to the net present value calculations for long-life assets and new capital projects, such as the Mildred Lake West mine extension. If the company cannot be assured of utilizing the full economic capacity of these assets due to regulatory limits on total emissions, future production growth could be severely restricted, potentially forcing a reallocation of capital away from volume-enhancing projects toward necessary but less profitable abatement technologies. Conclusion. Suncor Energy Inc. is positioned for a fundamental re-rating based on its successful execution of a management-led turnaround. The integrated structure remains the key source of financial resilience, offering stable cash flow generation insulated from extreme commodity differentials. The firm has demonstrated its capability to grow volumes and earnings through operational alpha, evident in the Q3 '25 record production and superior earnings growth despite flat commodity prices. This operational stability, combined with robust capital discipline, evidenced by the extremely low 0.5 times net debt to AFFO ratio, and the aggressive share repurchase program that retired 2.7% of shares outstanding year-to-date Q3 2025, creates a compelling investment. The stock remains fundamentally undervalued, trading at a significant discount with an EV to EBITDA of 5.6 times compared to key Canadian peers. This discount is expected to diminish as Suncor continues to demonstrate quarterly operational excellence and sustains its improved safety and governance metrics, eliminating the historical risk premium. While external risks related to potential WTI weakness, forecasted in the mid-50s for 2026, and the long-term threat of the federal emissions cap persist, management's commitment to cost reduction and a flexible lower 2026 capital budget provides necessary protection. The potential for multiple convergence, combined with continued accretive share repurchases, supports the consensus average price target of $47.72. Suncor offers defensive cash flow generation, a secure dividend yielding approximately 4%, and significant latent value that can be unlocked through continued high-quality execution.